I'm here to share with you about my stock account update. Today, my stock account has made a loss of $135. The US stocks closed lower on Wednesday, and the public is pending a vote on the debt ceiling deal. So, in my account today, I've made a loss of 0.18%, which is $135. Right now, the net asset of my account is $73,869.04. The United Natural Gas made a loss of 2.05%, decreasing to $6.2 today. The market generally closed mixed. Dow Jones Industrial Average closed down 0.41%, Nasdaq Composite closed down 0.63%, and S&P 500 closed down 0.61%. Today, the semiconductors closed down more than 3%, and oil and gas closed down more than 2% due to the decrease in gas and natural gas. The bank regionals continue to close down. On the other hand, the healthcare industry closed up with more than 1%. U.S. stocks closed lower on Wednesday. The two Fed officials signaled a pause in June. Investors are still waiting late Wednesday for the House to vote on the federal debt ceiling deal. The Fed's Beige Book reported slowing hiring and cooling inflation across the country. Wednesday was the last trading day in May. In May, the Nasdaq was up 5.8%, S&P 500 was up about 0.3%, and the Dow Jones was down 3.5%. The tech-heavy Nasdaq index outperformed in May, in large part due to the popularity in the AI sector. Nvidia's market value rose to more than $1 trillion on Tuesday, but many worry that the market lead force is too narrow. Andrew Smith, chief investment strategist at Delos Capital Advisors in Dallas, said, "We don't see any signs of broad participation beyond the AI sector. We see no early signs of the stock cycle." One factor that has weighed the market in recent weeks is the debt ceiling battle. President Joe Biden and House Speaker Kevin McCarthy announced over the weekend a deal to cap basic federal government spending for 2 years and raise the debt ceiling, but deals that have yet to get congressional approval. With just days left to avoid a U.S. debt default, the bill removes a key procedure hurdle. The Congress is pushing to pass the bill by June 5th, and the Treasury Secretary Janet Yellen has warned that the country is at risk of a default. The deal to pass passed the House Rules Committee by a 7-6 vote. The light vote in the House is expected to be held around 8:30 p.m. Eastern Time on Wednesday. Republican Representative Patrick McHenry said early Wednesday, "I think we have enough affirmative votes to pass this deal today." Even after passing in the House, the bill needs to pass in the Democratic-controlled Senate by the next Monday. Only 2 clauses can be signed by Biden. Some analysts say that the new procedural steps could take a week once a link prevents the bill from passing quickly. The Treasury Department expects that it will not have enough money to repay its debt by next Monday. Nonpartisan Congressional Budget Office estimates Tuesday that the bill would reduce the budget deficit by about $1.5 trillion over the next decade, in line with party forecasts, which could provide additional support for the bill. Many market concerns fear that the debt ceiling deal will drain a lot of liquidity from the market. Uncertainty over the U.S. debt ceiling has sent excess liquidity flooding into stocks, asset management from Moat Capital Management said. With the debt ceiling raising and the insurance of new bonds, the Treasury General account amounts could increase significantly. Bank reserve balances could decrease and the liquidity could be lost from the market, he said. On the economic data front, the U.S. Bureau of Labor Statistics survey of job vacancies and labor flows revealed 103 million job vacancies in April, compared with 9.375 million expected, compared with 9.59 million previously. The dollar jumped on the report, suggesting that the companies are still looking for workers. The market sees a 62% chance of a rate hike in June. The U.S. job vacancy in March was revised up. In April, each unemployed candidate had 1.8 jobs, and the vacancy rate rose to 6.1% from 5.9% in March. With the 103 million job vacancies. The hiring rate remained unchanged at 3.9% in April, unchanged from March at 6.115 million people. Job vacancy data said the data hit a rebound in the bond market as the 10.103 million figure far exceeded expectations. However, the data may overstate the labor market vitality as resignation fell to 2.4%, the lowest level since February 2021. A rise in the employment versus unemployment ratio from 1.67 to 1.79 could make the Fed once again consider the labor market tight. Analysts said the Chicago PMI data released a few minutes ago was much lower than expected, suggesting that the Fed is weighing its fall. All in all, the data keeps the chances of further tightening by the Fed within a range. The market sees it as quite high. The Federal Reserve's Wage Book released Wednesday, showing slowing hiring and a cooling economy in many parts of the country. In its Wage Book survey, the Fed said the U.S. economy has shown signs of cooling in the past few weeks, with a slight slowdown in hiring and inflation. It says the employment growth in most jurisdictions, but slower growth than previous reports. Prices rose moderately during the reporting period, though they have slowed in many jurisdictions. Economic activity was essentially flat in April and early May, the survey showed. The report compiled by the U.S. Chicago Fed was closed on May 22nd. Some Fed officials have already said a rate hike pause at the June meeting may be appropriate, but other officials cautious about inflation says action could be needed even if rates are not raised at the next meeting. After the Beige Book report, the two Fed officials indicated they would not raise the rates in June, dragging down market expectations of a rate rise. Fed Governor Jefferson hinted on Wednesday, suggesting that the Fed was inclined to keep the rates unchanged at the next month's meeting. Before Philadelphia Fed Chairman Huck also said the Fed should skip a rate hike at its June meeting. After the comments, the June swap fell to about 10 basis points from 16 basis points at the close of Tuesday's day, suggesting only a 40% chance of a 25 basis point rate hike and a 20 basis point forecast for the July meeting, down from the previous 27 basis point rate. After the OIS fell about 5.26% in an intraday low of 5.17%, reducing expectations of a rate hike about 9 basis points. Earlier this month, Fed officials raised their benchmark interest rate above 5% and suggesting they might need to be prepared to suspend the rapid tightening actions that began last year. Since then, stronger than expected economic data have reshaped the market expectations of another rate hike in June. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.